Ark Invest, innovation, Cathie Wood stocks the stock market. It took investors, especially new investors, by storm very soon after March of 2020, extending well into 2021. Cathie Wood and Ark Invest, it was the face that many investors and many new traders looked up to. There were countless videos, posts on social media, blogs, dissecting the stocks they were holding, the stocks they were buying, the stocks they were selling, and off of those moves that Cathie Wood and Ark Invest were making, those stocks would make even bigger moves just because Cathie was buying or selling shares. Every buy, every sell was seemingly under a microscope. And really for good reason, because Cathie Wood returned over 380% from those March lows to their highs in early 2021. Now that was not even 1 year, and the average market return is between 8 to 12%. So picture 383% in less than 1 year. Yeah, that was definitely something worth talking about. And there was definitely reason to be excited, especially if you're someone who is new coming into the market. Picture being able to multiply your money at that rate. It's astounding. Now fast forward to March of 2022, and the script has literally completely flipped. It's the exact opposite. Cathie Wood's ARK Innovation ETF, ticker symbol ARKK, is down roughly 65% from its February 2021 highs. And when it dropped below $60 in late February, it hit levels we hadn't seen since pre-pandemic times, pre-pandemic crash in early 2020. So as we said in a recent live stream, as we said before, if you were to go back to that point, January, February 2020, and you had invested $100, or let's say your entire net worth into ARK Invest Innovation ETF, and you went into a coma and you just woke up now, you would have roughly the same amount of money. Well, if you want to factor in inflation and the fees, well, you're actually doing pretty bad, and you may have less money than what you had before, at least purchasing power wise. And the recent downturn that Cathie and her ETFs are seeing, it's not going quietly. Investors, new traders, even experienced traders are literally kicking her while she's down. She's coming on CNBC, she's getting some attention, but a lot of questions are being raised. Why haven't you changed your style and your approach earlier to minimize the downside? Why are you still investing and buying these companies that continue to go lower and lower and lower, despite you saying they're in extreme value territory? So when we're talking sentiment, it's pretty bad. It's pretty negative here if you're holding these stocks and if you're holding her ETFs. But does that mean we should stay far away from Cathie Wood, any stocks she buys, or her ETFs? Or is this the time that we should really be considering adding some of these stocks to our portfolios, or even investing in her ETF if we don't want to buy individual stocks? So let's take a look at this graphic, and this graphic is from Investopedia, and it's on market cycles, okay? Markets go through these cycles all the time. Individual stocks, we can see overall markets, whether it's commodities, whether it's Cathie Wood stocks, whether it is Apple, whether it's Amazon. We've seen these patterns time and time again. They play out, but they play out on different time scales, and they play out really in different forms. So it's not like there's a one size fits all, or one specific picture, one timeline, one time frame fits all for everything. But this could be very beneficial to us and our uses, because it can help us identify something that has a lot of upside versus downside. So with this cycle, we have an accumulation stage, we have a markup stage where the prices and the asset prices generally head higher. We have the distribution stage where we kind of hit a top and things kind of chop around for a little bit, consolidate potentially, and we see less continued upward momentum, followed by the markdown phase where we seemingly have been in for quite some time, at least with ARK Invest and the innovation ETF here, ARRK. Quickly diving into what this ETF currently holds, the top 10 holdings. As we speak right now, we see a list of stocks: Tesla, Teladoc, Roku, Zoom, Coinbase. We keep going down the line, but we see a ton of stocks that have taken massive haircuts over the past year, right? So a lot of these stocks honestly look pretty similar to the overall picture that we're seeing with Cathie Wood's ARK ETF. Could all these stocks continue to go lower and drive the prices of Cathie's ETF sub 60 again, back down even sub 50? For sure. Now take a look at some of these returns. We talked about some numbers early on, but if you go back over the past year ending, this is only going out to the end of January, which things did even jump further in February, right down over 44%. Past 3 years though, up 21%, past 5 years, up 29%, and since the inception, 21% returns here on ARRK's innovation ETF. And at the end of the day, we do know a couple things about the stock market. That generally speaking, stocks tend to go higher and quality companies tend to go higher. The overall markets tend to go higher over time, as long as those companies can continue to grow, pad their margins, and continue to innovate, as Cathie Wood would say. So the way we see it is that there's actually a bunch of ways we could go about playing this. And we do want to talk about one thing very briefly that I'm sure you've heard before. And it's the famous Warren Buffett quote: "Be fearful when others are greedy, and be greedy when others are fearful." Okay? This is a time when we have what seems like everybody and their grandmothers all bashing Cathie Wood, saying, don't go near that, that thing continues to go lower, and they laugh, and they watch it continue to hit new lows each week, it seems like nowadays, and they continue to say, shouldn't be in that, good thing I have puts. Everybody, of course, is in puts right now because it keeps going lower. Apparently everyone saw it coming, and everybody is taking advantage of the downside. At least that's how it may feel when looking at your favorite Twitter trader on the internet that has never revealed their face, any actual numbers of their portfolios or stocks that they have been buying. They just talk about what happened after the fact. But then again, we understand this is part of the market cycle, right? We have these periods of time when at the top, everyone is so greedy, and at the bottom, everyone is so fearful. So again, like we said before, could it go lower? For sure. But if we go off of sentiment, we go off the market cycles, and we go off the investor psychology and trader psychology that we're seeing right now, this is one of the most scary times to potentially enter in and buy, but it could offer one of the better risk rewards we have seen in quite some time, especially for Cathie Wood's ETF. Now, here are a couple ways you could go about playing this. Number one, you could take a look at her ETF and just buy the top 10 holdings in your own portfolio and not have to worry about some of the stuff that is under the surface and having a million stocks in your portfolio. Or you can pick and choose your favorite stocks, whether it's 3, whether it's 5, whether it's 2. It doesn't matter. You can really see here that Cathie really likes Tesla, Teladoc, Roku, Zoom, and Coinbase. I mean, you can go off of just those 5 and say, hey, you know what? I really like Tesla, I like Zoom, and I like Coinbase. Roku and Teladoc, I don't really care too much. I'm going to buy just those 3, and I'm going to ride things out because I believe in these companies. I believe in the innovation. I believe in these in the next 5 to 10 years. And I'm not super concerned about what happens in the next 3 months. I'm more concerned about what happens in the next 5 to 10 years. And that could be a really good strategy. And now let's talk about an investing strategy we can also implement in doing so. Let's talk about the DCA strategy. You know, everyone wants to talk about, the momentum, the breakouts, and, making so much money and playing options and all this crazy stuff. But if you think about this strategy that has stood the test of time, and really no matter what market conditions, at the end of the day, throughout history has proven that on solid companies, on growing companies, on companies that are not going to go anywhere for the next 5-10 years, this strategy works. It really does. So we look at Cathie Wood's ARRK ETF right now, and maybe you're someone who is holding this ETF, or you're holding some of the stocks, or you have, a similar situation with a different ETF or a different stock in general. What we can do is, let's say we have an average right here around $120 per share, which you may look and say, that's terrible, I'm down so much, it's cut in half since then. It's not the end of the world. What I want you to do is I want you to DCA, dollar cost average, into the fear and the weakness. Now, these are the times that if you can deposit more money and you still believe in these stocks and this ETF, this is actually a time that you want to be maxing out, let's say a Roth IRA, or maxing out your monthly investments into your portfolio. Because in these times throughout history, right, with a longer term view of the markets, you're actually going to come out on top. So if let's say you make X dollars a month and you can invest Y, and that X happens to be $5,000, and you can invest $500 into the stock market every single month. Am I saying invest that $500 all into Cathie Wood's ETF? No, but I'm saying maybe it's $100 a month, maybe it's $200, maybe it's $250 for this stock or for the ETF. Whatever your investing approach is, I encourage you to consistently add into your account, add into a stock or an ETF that is headed down, that you believe in and will be around in the next 10 years. And if you do that consistently, you're not going to try to time the markets, because we know how that can go. You're not going to get caught up in the fear and the greed, and that's not going to be something you're going to have to worry about in the long run. It's cool to see. It's cool to see the ups and the downs and the craziness and the Reddit Wall Street bets, massive gains, massive losses. But at the end of the day, do you want to come to the casino every week or every month with your money that you've worked hard for? No, I don't think anyone wants to do that. Maybe with a portion of your money, a small portion that you're willing to have some fun with, but for a significant amount, we don't want to mess with that. And then what happens when Cathie Wood has a run, or these stocks have a run of 300% in less than a year. What do? We look to potentially trim into strength. If we have now reached a point where we're holding for over a year on that stock and you want to potentially lock in some longer term capital gains, then that could be a great idea and that could be a great thing to do. Or if you are not someone who's really going to care too much about your tax repercussions here and you just want to trim into the strength and utilize that money and have that money to buy back in at a lower price or for tax purposes, well, when everyone is praising and bowing down to Cathie Wood again or to Tesla or to Coinbase or to whatever stock, well, then that's the time that you might want to consider trimming into the stock and trimming into that strength if you feel like that stock is significantly exceeding the current valuations and currently what it may be worth, at least as of right now. But there is really no doubt that Cathie Wood and her stocks have taken a monster hit, and there is no doubt in my mind that there will be a significant bounce back. The problem is that too many investors try to get caught up in timing that bounce back and trying to trade around their position size or trade around these big moves, and they end up missing out on some of the biggest days that come when we least expect it, and vice versa. Some of the worst days come when we least expect it, and that was certainly part of the downside that we saw back in February of 2021 on Cathie Wood's ETF. But now I'm interested in hearing your thoughts in the comment section down below. Are you interested in buying the ARK Innovation ETF? Do you like some of those stocks there? Are you in line with that strategy that we laid out here in this video? Happy to hear you guys in the comments down below. Like always, all we ask is a thumbs up on the video if you got something out of it. Consider sharing with a friend if helpful. Make sure you guys are subscribed here to the channel and check out those links down below in the video description for any resources that may be helpful to you. We'll see you guys in the next video. Peace.